We're banging our heads on the end of the first half of 2021. Let's kick off here in Dubai with Ed Bell, Senior Director of Market Economics at Emirates MBD. Ed, good morning. We're opening in Asia this morning, a little bit down, but ultimately little change. But the trend this week ahead of the OPEC meeting seems to be softening on last week's rally up above $75 on Brent. Your thoughts on the outlook for the market this morning, Ed?
Yeah, I think what we're experiencing, not just in oil prices, but across asset classes more generally, is a little bit of anxiety as the market grows increasingly aware of the spread of this Delta variant of the COVID-19 virus, which is much more highly transmissible, and particularly transmissible among populations that haven't quite had the same level of vaccine penetration that we've seen, say, here in the UAE, for instance, or in the UK or parts of the United States. So the expectation that we could see more countries needing to either extend lockdown measures or actually have to reimpose them. We've seen them needing to be reimposed across much of Australia, a country that has largely been able to bypass a lot of the coronavirus pandemic, I think is weighing a little bit on sentiment towards consumption and sentiment towards growth more generally over the next couple of weeks.
Let's head off to New York, where we have Mike McGlone from our friends at Bloomberg Intelligence, Senior Commodity Strategist. Mike, clearly the U.S. continues to be the engine of growth, but as OPEC sits down to read the tea leaves, should they be confident to open the taps and release some more oil, really based on the picture in the U.S.?
No, they shouldn't. So let's look at, I've been comparing unleaded gas demand from a 24-month rate of change. You can't compare to last year. It's down about 6 to 8%. It depends. It's been actually the same as it's been 20 years, around 8 to 9 million barrels a day. It fluctuates between there, dropped, quite a bit 2020. But I think that's the key thing. OPEC has to maintain discipline. It cannot put supply back on the market. The stock market has to stay strong. We need massive optimism. Things will just return right back to normal. And I see crude oil around $73 or 70 up to 75, and Brent's much more likely to head towards 50. And the key thing I see is we haven't had a substantial correction in the stock market or crude oil since the bottom last year, but finally we're getting peaks in corn and copper and lumber. And crude oil to me is just the next iteration to fall. And unless the stock market continues to go higher, crude oil is just going to stay the same. Once we get a little bit of a correction, a little bit of normalization, the stock market crude oil should just go right back to its mean for the last 5 years, which is closer to 50. And the bond yields are telling us that we're more likely to just mean revert a little bit.
Let's welcome in Singapore, Leo Tamiris, Chief Executive Officer of NRG Global. Leo, are we going to be once again looking to Asia to be the growth of incremental demand as they emerge from the COVID crisis, or are we seeing the possible dampening, like we're seeing in Europe, of this Delta variant sort of slowing things down in Asia as well? What is your outlook this morning?
I think the optimism is going down. That there is a realization that the spike in cases, especially here in Asia, is structural. It's caused by a much stronger variant, the Delta variant, and overall vaccination levels are very low still in Asia. There are only 3 countries in all of Asia with vaccination levels fully vaccinated over 10%. That's China, Hong Kong, and Singapore. All the rest is below 10%. So if then the stronger variant comes in, then you will get increasing lockdowns again. You have restrictions again. So that will weigh down on the growth prospects.
And Leo, is there any indications? I mean, this low level of vaccination has been with us now for months. I mean, since vaccinations emerged in late last year, Asia has never really demonstrated an urgency about stepping up their campaigns. A little bit in India during the crisis in the second quarter. But is there any sense that Asia really recognizes that vaccines is the gateway to the future, or they're still somewhat laissez-faire about it?
No, I think it's very clear now to most countries that that's the way to go, and that we should in a major way step up the vaccination rates. It's some of the countries that maybe cost factor, cost element. If you look at in Indonesia, 250 million people to be vaccinated. That's a huge cost, of course, for the government to bear. Accessibility. In a country like Indonesia, spread over 14,000 islands. You need to get to all those people as well. The same in Philippines and big countries like in India. But the realization that vaccination is absolutely necessary is certainly there. Yes.
Ed, one of the sort of big stories leading into this OPEC meeting has always been the return of Iran, the negotiations in Vienna of the nuclear agreement. We've seen overnight a spectacular collapse of sorts in that rapprochement effort, where we have the US and Iran, US in sort of military engagement with what they call Iran-backed militias in Syria and Iraq, and retaliation then from the Iranian-backed militia side. So this looks like a pretty direct, hot version of the collapse in Vienna. How do you read that, and how significant do you think it could be for the outlook of the nuclear agreement?
Yeah, I mean, I think for the last 6 weeks, every week seemed to be the final week of negotiations among the JCPOA parties. But as you say, we've kind of hit a bit of a crucible in terms of, is this perhaps the Biden administration sort of issuing a warning or threatening to the president-elect in Iran, Ibrahim Raisi, that they're not going to tolerate supposed Iranian or alleged Iranian militia activity across much of the rest of the Middle East? And I think this was always kind of an inherent fallibility of the negotiations in Vienna, is that the Iranian position wanted to take a wholesale approach to negotiations of sanctions being removed, full stop. So not just nuclear related sanctions, but ones related to their activity across the rest of the Middle East, whereas the United States position seemingly was very much related to, no, it's only going to be the nuclear related ones. So we have this escalation in geopolitical tensions between both sides that's probably, as you say, not going to do much work in terms of getting a deal or allowing a deal to be reached much easier over the next couple of weeks. So far, we haven't really seen much of a reaction to that development as far as oil markets go. I think we had a bit of an upward move in prices probably in the last week and a half, as it looked like the pace of a restart or a pace for Iran to come back into the oil market in a more meaningful way keeps getting pushed further and further down towards the back end of this year. So I think when we were at the start of the June, seemingly the negotiation or the tone around negotiations was quite positive, but by the end of June, we've gone quite negative. So the outlook for Iran to come back to the market in a more meaningful way does look like it's getting pushed back significantly into the second half of the year, if it's going to happen at all.
And Mike, on the back of that, just sort of challenging your earlier thesis, I mean, we've got the Iran oil supply challenge to OPEC off the table now. We also seem to have shale, at least in the foreseeable future, anything significant this year, off the table. So from a supply challenge point of view, OPEC seem to have a clear pathway ahead of them. And really, they're now forecasting deficit of, demand over supply in the second half of the year. And global inventories are moving well below the 5-year average. So all in all, my point again, is that not the sort of circumstances in which adding back supply is, pretty clear and easy one to do?
Price to the market. Right now, the cost of production in the U.S., or the price of crude oil, is 73% above the cost of production average shale. It's the highest I have in my database for 7 years. So we can eliminate supply and demand economics. Maybe that supply won't come back on. I can say good luck with that one. Good old get her done America and Texas, they're going to produce oil at that price. And that's what OPEC's been doing for 20 years. They make the price too high. Shale comes back on, reduces demand, and I wish them luck. But it's not the old market anymore. It's, first of all, we have technology taking over rapidly. Your average person doesn't drive as much, not going to work. Their vehicles are much more efficient. I'm one example. My vehicle gets 80 miles per gallon. It's hybrid electric. We're all going that way. And then there's this dependence on the equity market. That's what's changed. The correlation between the crude oil and the stock market is the highest in my database, is going back to 1960. So that tide has to keep rising. Just a little ebb and crude oil drops at double the velocity. So for me, for 2H, I think much better prospects for gold. I see gold has dropped a good support. Bitcoin's had a decent correction. I see crude oil bumping up, but there's really good resistance on this massive optimism. So I'd rather be a buyer of gold, seller of crude oil for 2H.
Leo, are we sort of being too quick to dismiss the impact of Iranian supply, given that apparently there is a significant volume on floating storage in Asia ready to go if indeed an Iran deal is done? What's your reading on where storage is at the moment, given the backwardation market?
Well, the Iranians or the counterparties, they're putting large volumes on afloat, both in the Gulf and around here, around Malaysia and in China waters. I think if there is a deal done, if officially they can open the sluices again for crude oil, but I think the surprise will be on the downside. I mean, there will be less additional oil coming into the market than what is there already. Iran has continued to export oil, but it was not visible, and they got very good at making it invisible. But so I think the impact will be a surprise on the downside. It will be less additional oil than what simple calculations would show.
What about the situation in China, Leo? We're seeing in recent weeks the sort of attempts by the authorities, the regulatory oversight there, to penalize certain importers who are dealing with Iranian crude, as well as other more stringent regulations around quotas. What's your sense about what the Chinese are trying to do there, and what's the outlook for it?
I think they're trying to clamp down on smuggling and on more than anything else. I don't think it's aimed at specific origins, specific producers. They're trying to clean up, in a sense, the import structure, because what you've seen is huge imports of products that would depress the refining margins in China itself. So they've now substantially increased some of the import taxes on some of these products. I think it's more than that than anything else. It's not aimed at certain producers or trying to get the producers out.
What's the outcome of that in the second half? Will we see less imports? Will we see more drawdown in Chinese stocks?
No, the stocks are being drawn down inside China. I think there will be a lot coming out of stocks that are afloat already that they haven't bought yet, so that still have to be imported. The refining, I don't think the refining will go down. Will continue its growth in China, but it's at a slower pace. We see some cracks appearing in the growth in China. I mean, the World Bank still predicts an 8.5% GDP growth this year, but down to 5.5% next year. Some other reports talk about a retail coma, the slow recovery in consumption. Wednesday we'll see the PMI coming out, which is expected to still be above 50, but lower than last month. The credit restrictions are they're very tight credit controls at the moment. Loan rejection rates are very high. So we see some a lot of cracks appearing in the what we thought even a few months ago would be an enormous growth again in China. I think it will be slower than what the statistics indicate at the moment.
Ed, coming back to the OPEC meeting, we read an interesting piece by one of our regular commentators here, who this week was saying that the idea that this is a real opportunity for OPEC to put barrels back in the market, to claim market share back, with still 5 million barrels on the sidelines. Robin Mills has been arguing a while, and again today in the National, this is a clear opportunity to do so without too much downside risk. OPEC need to be bolder. Your thoughts on that?
Yeah, I would agree. We put out a note recently that argued very much the same, that a lot of the variables we've talked about, the improvement in demand that we're seeing in the United States, the fact that inventories have been drawing down pretty much wherever you look, the fact that we haven't seen yet a real supply response from outside of OPEC plus countries provides you with this avenue to be, and the potential that the return of Iranian oil gets delayed even further. All of this offers an opportunity for OPEC plus to be able to increase production, perhaps not return everything back from August or into the second half of the year, but to incrementally add more and more. However, the statements that we're seeing from the kind of OPEC ministers that really matter is that they still want to be erring on the side of caution. You know, we've had statements out from Prince Abdulaziz in Saudi Arabia saying that he's been accused of being excessively cautious, but it's been paying off. And is there really a desire for them to want to derail the outlook for oil prices when we look sustainably above $70 a barrel in the Brent market by adding another 2.5 million barrels a day? I do think we probably expect to see a cautious increase at this meeting, maybe in the order of, say, 500,000 to 750,000 barrels a day for, say, August, the 3 months from August onwards, and perhaps a reassessment after that. But
would you say that on a monthly basis, like over the 3 months, 2 million, like we saw the last 3 months, or just 700 over the 3 months?
Exactly. Yeah, over the 3 months. So not an incremental addition each month. I do still think that they still want to err on the side of being overly cautious and running the oil market hot. Let's not forget that this is not just, these are not just economies that are there in the service of oil consuming nations. We've obviously heard statements out from India, again, the oil minister there, basically calling on OPEC countries to increase production to help to clamp down on inflationary pressures that are building across a lot of the emerging markets and indeed in developed markets as well. But, you know, for economies that are still reliant on oil prices, why not take the advantage of earning the high oil prices at this time? That sets us up, though, for what could be potentially a contentious oil meeting this time, OPEC meeting this time, or going forward, where you have those countries that have said, you know, we've had comments out from Russia's energy minister saying $70 is enough. We don't want to go much higher. We'd expect to see probably similar pressure coming from the UAE, which has been reticent to really endorse this extended period of prolonged production cuts. They want to be able to take advantage not just of the prices, but the opportunity to increase or capture more market share. But so
I just struggle with seeing how going to a month-to-month approach serves OPEC. I mean, it gives them the ability to lever, but at this stage, I think they need to be giving line of sight a little bit further out, as they did in the last quarter. Going month-to-month at this point would, I think, bring in volatility. Mike, looking at your corner of the world, obviously the big expectation for the Biden infrastructure bill has been dramatically reduced. I mean, it was talk of over 2 trillion. Now we're holding on to just above 1. What's your outlook for that? And with it, what's the appetite for further stimulus in the U.S. economy?
The stimulus will come after we have a bit of a correction or slow down this current sugar high. So to me, that's part of what you will see. It's right now it's done. There's not a lot of political will for it. But the key thing about the Biden administration is midterm elections are coming up, and everything they do, they have to get done before the election. So Republicans have pushed back a little bit on the stimulus, but it's still coming. You got to get it in before next November, because that's when typically things swing a little bit, and you need to buy those votes. So I fully expect more of it, but that's the key thing, I think, is Ed described the key ceiling in the market. And there's a bit of a floor underneath, because we know it's coming, but the key thing everybody's seeing now is we're about a ceiling in everything. And bond yields have figured that out. Copper's figured it out. Lumber's figured it out. Corn's figured it out. Crude oil is the one dangling carrot I think is going to have an issue going any higher. And if it just does what it's been doing for the last 6, 7, 8 years, it's going down. And depend on this stimulus, good luck. That doesn't mean crude oil, means copper. And copper's already said, sorry, we're done. We're not going above $10,000 a ton. And the Chinese put the kibosh on it. And there's any country that can, they did. And they probably continue to.
Leo, on the point that Ed brought up, the sort of the pain to the emerging markets, and India typically the most vocal amongst them when oil prices get too high. My thoughts would be is that the sort of moaning or the complaining hasn't been that great. I'm wondering, from your perspective, what is Asia, the emerging markets of Asia's ability to absorb this higher oil price at this particular time as they try to emerge from COVID? Is it a burden too far, or can they absorb it given the weak dollar?
Well, there isn't a lot of noise around it, except for India. I think most countries are able to absorb this and work with it, deal with it. And also because their activities are on a much lower pace. People travel less. People so transport fuels either by road, ship, or air is a lot less. So the impact is less seen, less felt by most people. But there's not much noise around, except for India, of course, where the gasoline prices at the pump are record high at the moment, and maybe not record high, but very high at the moment.
Mm.
And that's creating a lot of India is a clear price sensitive country, so that is bound to create a lot of noise and pushback from the Indian government to OPEC, who they perceive to be able to influence prices if they can.
Let's go to the survey and get everybody a chance to comment on some of these themes. With prices running ahead of recovery, now is the time for OPEC Plus to be bolder in regaining its lost market share. Agree or disagree? This is the thesis actually lifted from Robin Mills' op-ed in the National today. Highly recommend you have a look at it. Ed makes a good argument on this point, but or not Ed, sorry. Robin, but with prices running ahead of recovery, now is the time for OPEC to bolder in regaining its lost market share. Agree or disagree? Let's take that view. We'll go around the table and sort of get a view from our guests on what they think OPEC will do, maybe rather than what they should do. Let's sort of take the temperature of what they will do, starting with Ed Bell at Emirates MBD. Ed, your thoughts on what do you think OPEC will do when they meet this week?
Yeah, I think that we'll get an agreement for a modest increase from the August period onwards. It's not going to be one that I think is going to push the market anywhere closer to being in surplus. We're still going to be running a considerable deficit in the second half of the year. And I think the market is really pricing that in at the moment. So time spreads are still very much backwardated, particularly in the Brent market. We've had a little bit of a pullback in the last 2 days, but I don't think we're going to get some kind of full-scale endorsement of we're going to return half of everything we've taken off the market for the second half of the year. I think there is still too many unknown variables that don't respond to economic signals. You know, the Delta variant is going to spread. It's going to cause more lockdown measures potentially being introduced. And I think from the OPEC economy point of view, it's in their interest to try and keep more offline at the moment and keep those high oil prices for longer.
I mean, you would have said, Ed, that the Gulf states, obviously the drivers of the OPEC, Saudi Arabia, UAE, would have been quite content with $65 on Brent. It gave them a significant uplift on the fiscal side. Now, are you signaling that actually they prefer, obviously they prefer higher without the consequence, but from the fiscal point of view of the regional economies, how important is this price level? How big a difference does it make? And I suppose it gives us some insight of how attached they will be to it.
Yeah, it's still fundamentally crucial for all government revenues, for current account revenues across the region to ensure the stability, the financial and fiscal stability of the governments here. We just had an announcement overnight or data release out from Saudi Arabia showing that reserves fell to their lowest level since 2010.
Foreign reserves?
Foreign reserves, yeah, in the central bank. Now, admittedly, it was a very modest decrease month on month, and we've been basically flat or stable at around sort of $440 billion since about May last year. But I think there is going to be scope or interest among the Gulf countries to really take advantage. Hey, we've had a couple of years where oil prices have been down for a long time. Why not take the time to rebuild those fiscal buffers? The question we're wondering about is when does that rebuild in the fiscal position actually translate into a positive fiscal impulse? That's not something we're seeing. For instance, we're seeing here in the UAE that actually probably had a balanced fiscal budget in 2020 when the rest of the world was spending madly trying to shore up their economies. We didn't get that in the GCC last year. We didn't get that additional spending.
We got the opposite. We got austerity. We got triple VAT in Saudi Arabia.
Yeah. So we're not really seeing the high oil prices necessarily pass through to positivity towards the rest of the economies.
Mike McGlone, your thoughts on what the OPEC will do rather than should do?
Well, let's tell what they have to do, which is very unlikely. Some likely uncombination. There's an unlikely combination necessary to keep oil prices higher. And the head of that is OPEC has to maintain their discipline, which is typically an oxymoron in history. So if you just look back at the history of crude oil in the last 5-10 years, it's got nothing going for it. It's very unlikely to continue higher. OPEC has to maintain that discipline. And every time I have a conversation about all the supply that they have to hold back, to me, that's a bear market. You have to hold back the supply. Normal supply and demand metrics like you see in natural gas in the US means crude oil should drop about $20 easy. When you have normal supply demand metrics without someone artificially holding back supply, then markets go to a natural price. And right now this price is unnatural because these massive suppliers on the entire planet, most notably OPEC, are holding back supply. It's just a matter of time. In addition, we have to have demand come back, which is unlikely. We have to have the stock market keep going, which is unlikely. And the bond market's already starting to sniff it out. Copper sniffed it out. Copper, crude oil, not crude oil, corn, lumber, you name it. Virtually every commodity I look at is peaked. Crude oil is just the one dangling carrot, the way it's seen. OPEC's good luck. They got to maintain a discipline, which, as I mentioned earlier, is typically an oxymoron.
Mike, how confident can OPEC be in meeting this week with the view that the American economy is just a one-way line? And we were seeing Europe having a multitude of setbacks with the COVID variants and so forth. It appears from a distance, at least, that the US just seems to be in like the juggernaut is heading one way without interruption. Or can we expect that the US will also struggle? We saw the UK push out by a month a lot of its reopenings. Ireland are announcing today that they're also delaying openings for another month due to the variant, the Delta variant. But the US, anything there that could set back the opening?
Yes, normalization. U.S. economy is on the most excessive sugar high in its history. The most significant amount of fiscal monetary stimulus in a short period of time ever is just starting to wear off. It's just a matter of time. This is the bounce. Now we go back to normal. What was the market like before COVID? It was a bear market. So I think it's going to be worse. The difference now is the world did change. People are just nowhere near driving as much. I see that in my firm. I'm really shocked how most people are reluctant to come back. They're only coming back if they have to. They're not getting in the car and driving 5 days a week to work. That's just gone forever. So I say good luck with that one. The world's changed. Everything's going more efficient. We have more supply, less demand, and crude oil prices are elevated. And the rest of the other markets, like I say, the bond market's figuring it out.
So your guidance, OPEC, is maybe not be too deluded by the sugar bounce. Let's go to the survey question and give Leo the last word this morning. Agree, a big 2-1 to nearly 3-1, agree with OPEC should be bolder in regaining its market share. Leo, your comments on what OPEC will do rather than should do and what that means for Asia.
Well, I agree as well. I think they will surprise with more output than we expect. They're looking at Iran. That may not happen, and if it happens, the impact will be less than what is expected. Like Christopher Rule said on Sunday, where's the shale? And even at $75, it's not coming to flood the markets. So I think they see a gap. They see an opportunity to put more barrels in there and regain some market share.
Yeah, that would seem like if they don't do it now, when will they do it? That seems to be a question of consideration, and we'll certainly be bouncing that around all week ahead of the July 1st meeting. Well, let's wrap it up there and thank Mike McGlone in New York, Ed Bell in Dubai, and Leo Tamiris in Singapore. A great round the world in half an hour. Really appreciate your thoughts and insights, and we'll catch up to you in the coming days. All the best. Thank you.